From London now is Razia Khan, head of Africa research at Standard Chatred. Razia, let's review the economic data that we've seen out this week and starting with the dismal unemployment rate ticking up to that 25.3% level for the second quarter of 2010, first quarter being at 25.2%. So the picture is not improving in South Africa. Your view on the effect that this ultimately is going to have on the economy?
Sure, I suppose of all of the week's data releases, perhaps that slight uptick in unemployment was the least worrying of them all, simply because you would expect unemployment to be rising even after the economic cycle has turned. So we're starting to get year-on-year positive growth in South Africa again. It isn't unusual that the unemployment rate should still rise. It is, of course, a lagging indicator. But perhaps it was that combined with the week's other data pointing to subdued economic growth that provided room for concern.
And well, Razia, let's start with
component of that.
That's exactly where we're coming to in terms of what your biggest concern is over the economic data that we've seen out this week.
Sure. Well, just to take that unemployment figure, not a surprise that it should be ticking up. That's to be expected at this time of the cycle. But perhaps the picture that it paints about what is going on with the South African economy, we did see that the informal sector did manage to add considerable jobs growth. But that was meaningfully absent from the formal sector. And this isn't so much a cyclical issue. It's more a concern about the South African economy on the whole. Why is it easier to add those jobs in the informal sector? What is preventing that from translating into formal sector job creation? And that, of course, goes to the roots of some of the structural issues that South Africa faces. But in terms of your question, very difficult to pinpoint exactly which data release was the most worrying, which pointed to weaker growth. Perhaps CPI, given expectations that we might see some sort of uplift in June. That was, of course, the month of the World Cup. Actually, there was no real opportunity in those figures to look at significant price increases. We saw, of course, the rise in hotels associated with the World Cup, but otherwise that data release significant for almost the complete absence of any meaningful signal of opportunistic price increases, suggesting that there still isn't much pricing power in the economy.
When we saw that data come out at 4.2% for June, we saw the retail stocks, or those stocks that have exposure to interest rates, to the interest rate environment, rallying in anticipation of an interest rate cut come September. The market was divided on whether we were going to see a cut this time around. But September, your call, do you think we're going to see a cut? I think I remember that you were looking for a cut at this last MPC meeting.
Absolutely. Standard Chartered perhaps being in something of a minority looking for that cut at the July MPC meeting. It didn't come through, but we did get an awfully dovish statement on the whole, warning about the weakness of South Africa's own economic recovery and the threats to the external environment. Now, of course, the SARB will be doing an assessment of what has changed between July and September, but we continue to hold that there are very good reasons for South Africa to think of resuming its interest rate easing cycle. It really doesn't matter, it shouldn't matter that other emerging markets have moved to tightening. We've seen South Africa's own growth cycle lagging far behind those other emerging markets. South Africa may not have seen as dramatic a contraction with the global economic crisis, but if we look at the levels of growth, we're not much higher now than we were pre-crisis, and that's a concern. The economy isn't adding enough growth. There are signs that there is a recovery underway, but a very subdued recovery, and questions do need to be asked about whether this is good enough for South Africa. We think the consumer isn't there. There's certainly room for further interest rate easing.
And Razia, we're nearly out of time, but if you can just give us your thoughts on the trade surplus, which came out today. The market was expecting a small trade deficit. Your initial thoughts on the number?
Again, knee-jerk reaction, positive for the rand, a surprising surplus, but it pointed to healthy export growth, especially after the disruptions that we may have had with the transport strike in May, but also the weakness of import demand, that subdued import demand being a very consistent theme for South Africa. And the question is, what is it going to take to move to a healthier economic recovery where perhaps import demand isn't going to be as sluggish as we've seen? So all in all, rounding off a week where almost without exception we have seen signs of economic weakness continuing with the data, and we at Standard Chartered believe this is sufficient reason for the SARB to think very seriously about a 50 basis point rate cut in September.